The Federal Reserve has printed more money in the last 4 years than in the previous century combined. Yet inflation remains stubbornly below target in most categories, economic growth crawls forward at anemic rates, and millions of Americans report feeling financially squeezed despite record stock market highs. This isn't a contradiction. It's the mathematical result of a phenomenon economists call the velocity of money, and it's happening at a scale that threatens the foundation of monetary policy itself. When money stops moving, economies freeze, not in dramatic crashes or obvious collapses, but in slow, grinding stagnation that feels normal until you realize what's been lost. Money velocity measures how quickly dollars change hands in an economy. Think of it as the economic equivalent of blood circulation. When you spend $1 at a coffee shop, that dollar pays the barista, who spends it on groceries, where it pays a cashier who uses it for rent, and so on. Each transaction multiplies the economic impact of that single dollar. For decades, this circulation remained remarkably stable. The velocity of M2 money supply hovered around 2.0, meaning each dollar generated $2 of economic activity annually. This wasn't just a statistic. It was the invisible foundation that made monetary policy predictable, economic growth sustainable, and financial planning possible. Central banks built their entire framework around this stability. When they wanted to stimulate growth, they added money to the system, confident it would circulate and multiply. When they wanted to cool inflation, they removed money, knowing the effect would ripple through the economy. This relationship was so reliable that it became the cornerstone of modern macroeconomic theory. The velocity equation appears simple. GDP equals money supply multiplied by velocity. But this mathematical relationship masks a complex web of human behavior, institutional dynamics, and technological change that determines how money actually moves. Velocity depends on confidence. When people believe the future will be better than today, they spend, invest, and take risks. When uncertainty rises, they hold cash, delay purchases, and avoid debt. This isn't just personal preference. It's rational behavior in the face of systemic uncertainty. Banks amplify this effect through fractional reserve lending. When velocity is high, banks lend aggressively because borrowers are confident they can repay. This creates new money through the lending process, accelerating velocity further. When velocity drops, banks tighten standards, reducing money creation and slowing velocity more. The result is a feedback loop that can accelerate in either direction. High velocity breeds higher velocity until it reaches unsustainable levels. Low velocity breeds lower velocity until the economy approaches stagnation. Something fundamental changed after 2008. Money velocity didn't just decline, it collapsed. The M2 velocity ratio fell from 2.0 to 1.1 over 15 years. This represents the most dramatic monetary shift in modern economic history, yet it happened gradually enough that most people never noticed. The collapse wasn't triggered by a single event, but by a convergence of structural changes that reinforced each other. Demographics played a role as aging populations naturally save more and spend less. Technology changed spending patterns as digital platforms captured larger shares of economic activity while employing fewer people. Most importantly, trust in traditional economic relationships eroded as institutions repeatedly failed to deliver promised outcomes. Quantitative easing accelerated the decline by changing who holds money and how they use it. When central banks purchase government bonds and mortgage securities, they inject money directly into financial institutions rather than the broader economy. This money tends to stay within financial markets, inflating asset prices without increasing consumer spending or business investment. The wealthy, who receive most newly created money through asset appreciation, have lower marginal propensities to spend. They are more likely to save additional dollars or invest them in financial assets that don't directly create jobs or increase production. Meanwhile, lower and middle-income households, who would spend additional money immediately, receive little benefit from monetary expansion. The data reveals the scope of this transformation across multiple economic layers. Business investment as a percentage of GDP remains below pre-2008 levels, despite record low interest rates and abundant liquidity that should theoretically encourage expansion. Corporate cash balances have reached historic highs, while capital expenditure growth lags, creating a paradox where companies hoard resources rather than deploy them productively. Small business formation, once the engine of job creation and innovation, has declined significantly since 2000, with new business applications falling to multi-decade lows. Before the pandemic temporarily reversed this trend, the shift becomes more pronounced when examining investment patterns by sector and geography. Manufacturing investment has particularly stagnated, with many companies choosing to buy back shares or acquire competitors rather than build new capacity. Technology firms, despite generating massive cash flows, increasingly focus on financial engineering rather than research and development that could drive broader economic growth. Meanwhile, infrastructure investment remains chronically underfunded, creating a growing maintenance backlog that will require massive future expenditures. Consumer behavior shows similar patterns of caution and delay. Personal savings rates spiked during the pandemic and remain elevated despite government transfers and improved employment conditions that historically would have triggered spending increases. Consumer debt levels are rising, but slowly and selectively, suggesting widespread reluctance to leverage future income for current consumption. Credit utilization rates remain below historical norms, even among creditworthy borrowers who could easily access additional financing. This behavioral shift extends beyond simple financial metrics into fundamental changes in how people perceive economic opportunity. Survey data consistently shows declining confidence in traditional wealth-building strategies, with younger generations particularly skeptical about home ownership, entrepreneurship, and long-term employment relationships. The gig economy, while providing flexibility, has fragmented income streams in ways that make large financial commitments feel riskier than previous generations experienced. Household formation rates have declined as economic uncertainty makes major life decisions feel premature or financially irresponsible. Marriage rates correlate strongly with economic confidence, and delayed family formation reduces the kinds of large purchases that traditionally drove consumer spending cycles. This demographic hesitation creates a self-reinforcing cycle where reduced spending leads to slower growth, which justifies continued caution about major financial commitments. Financial markets tell the same story from a different angle. The correlation between stock prices and economic growth has weakened dramatically. Markets rise on monetary expansion while underlying economic activity stagnates. Trading volumes in fixed income markets have increased exponentially while real interest rates remain near zero or negative. Perhaps most telling, wages continue to lag productivity growth despite labor shortages in many sectors. This suggests that productivity gains are being captured by capital rather than shared with workers, reducing the spending power of the largest group of potential consumers. Regional data adds another layer of complexity. Velocity varies dramatically across geographic areas, with coastal cities and financial centers showing higher rates than rural and industrial regions. This geographic concentration of monetary velocity creates localized bubbles in real estate and services, while vast areas experience effective deflation. Low velocity creates winners and losers in ways that compound over time. Asset holders benefit from monetary expansion without corresponding increases in consumer prices. Real estate, stocks, and bonds appreciate while goods and services remain relatively affordable. This dynamic transfers wealth from savers and wage earners to investors and property owners. Financial institutions face a more complex situation. Banks struggle with compressed net interest margins as velocity decline, reduces loan demand despite low rates. Insurance companies and pension funds cannot generate returns sufficient to meet obligations, creating unfunded liabilities that must eventually be addressed through higher premiums, reduced benefits, or taxpayer support. Government finances improve in the short term as low velocity keeps inflation moderate, reducing pressure for interest rate increases. Federal debt service costs remain manageable despite record debt levels. However, low velocity also reduces economic growth, limiting tax revenue growth and making debt to GDP ratios more difficult to improve. Young adults and first-time borrowers face particular challenges as low velocity reduces economic dynamism. Job growth concentrates in asset-light service sectors that offer limited advancement opportunities. Traditional paths to wealth accumulation through home ownership and small business creation become more difficult as asset prices rise faster than wages. International trade relationships shift as countries with higher velocity gain competitive advantages over those trapped in low circulation patterns. Nations that successfully maintain monetary circulation attract investment and trade relationships, while low-velocity economies become increasingly dependent on asset appreciation to maintain living standards. This creates dangerous imbalances in global capital flows, with money seeking the highest returns rather than the most productive uses. Central banks find themselves trapped between competing objectives that their traditional tools cannot reconcile. Lowering interest rates further risks creating asset bubbles without stimulating real economic activity. Raising rates could trigger deflationary spirals in an economy already struggling with insufficient circulation. Quantitative easing continues to inflate financial assets while failing to reach the broader economy, where spending would actually increase velocity. The European Central Bank faces particularly acute challenges as negative interest rates have failed to stimulate lending or investment across the Eurozone. Japanese monetary policy serves as a cautionary tale, with decades of low rates and quantitative easing producing persistent deflation and economic stagnation. These experiences suggest that once velocity declines below critical thresholds, conventional monetary tools lose their effectiveness entirely. Emerging markets that maintained higher velocity rates through the 2010s are now experiencing their own deceleration as global financial integration spreads low-velocity patterns across borders. Capital flows that once brought growth and development increasingly seek financial returns rather than productive investment, creating boom-bust cycles that further erode confidence in economic institutions. The cryptocurrency phenomenon reflects partially this velocity problem, with digital assets representing an attempt to create alternative circulation mechanisms. However, most cryptocurrency trading remains speculative rather than transactional, suggesting that technological innovation alone cannot solve fundamental confidence and inequality issues that drive velocity decline. The velocity trap presents no obvious solutions because it reflects structural changes rather than cyclical downturns. Monetary policy tools designed for a high-velocity economy may accelerate asset bubbles without stimulating real growth. Fiscal policy faces constraints from debt levels that accumulated during previous stimulation attempts. The mathematics are unforgiving. If velocity continues declining while money supply grows, either inflation must eventually accelerate dramatically, or economic growth must slow to accommodate the imbalance. Neither outcome aligns with current policy objectives or public expectations. What emerges is a system operating far from historical norms, where traditional relationships between money, growth, and prices no longer function predictably. The question isn't whether this situation is sustainable, but how long it can persist before something gives way.